The economy's on fire. At least that's the way it looks from the latest PMI data. But what are these purchasing managers indices, and what do they mean for the global economy, and more importantly for our investments? It's not always a good story if economic growth is very strong, as we'll see. Now, if you do want to learn more about investing and the economy and how the two match up to one another, a great way of doing that is by signing up for our free weekly market roundup. You'll find instructions on how to do that by clicking on the link in the description and on the link beside me. So let's look at how the economy is on fire in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. So what evidence is there that the economy is on fire? Well, there's a company called Market, and it publishes something called Purchasing Managers Indices. And the idea behind PMI indices is that they give you a timely reading on how well companies are doing within a country or within a sector. Now, these indices are published every month, and they're based on surveys which are sent out to thousands of companies where they look at their current business conditions and how they expect those business conditions to improve or get worse in the future. They then take those responses, aggregate them, and boil them down into a single number, which is the PMI index. And this is called the diffusion index, where if it's 50, that means things are staying pretty much the same. If it's above 50, that means things are improving. And if it's below 50, things are getting worse. So beneath me here, you can see the PMI indices for the US, the UK and Japan, and also the Eurozone. You can see the neutral bar here is 50, which means that things aren't improving or getting worse. And during the pandemic, all of these indices went down to extremely low levels, record lows in fact, and then completely predictably they bounced back. But what's interesting is that recently, since that bounce back, they've actually started to accelerate upwards in many countries, particularly for the US, that's the green line here, but also for the UK, and although it's slightly delayed, for the Eurozone. The only laggard, which you can see below 50 here, is Japan, and that's because of a resurgence of the virus in Japan at the moment. If we look at that data in the form of a table, you can see that for the US and the UK, they're actually showing a record expansion. It's never been higher. Australia's already had a record high, and it's just slowing down slightly from that record high. And the PMI indices in Europe, in Germany, France, and the rest of the Eurozone are very high, but not yet at record levels. And here you can see that Japan is the only region where the number is below 50, suggesting there's a slight contraction. So here's the composite PMI, which combines two sub-indices, one for the manufacturing sector and one for the services sector, which is more important, and both of those are for the US. So here's the PMI number in green, which is oscillating above and below 50, and notice how generally it tends to lead GDP, which is economic growth in the US. The other drawback with GDP as an investor is that it's backward looking and it's only published quarterly, whereas these PMI indices are published every month. So the latest PMI number is suggesting that the next GDP print in the US will be a very strong one. And that's the evidence that suggests in the months ahead, economic growth will be very strong in many countries across the world. Now, if you're enjoying this video and you don't want to miss any new ones, then don't forget to click on the subscribe button. And also it helps us if you like this video. Now, Market runs its own models which take the PMI indices and try to forecast GDP. And when they put in the latest PMI numbers, you can see growth for 2021 is looking very strong indeed. And the colours here are green for global GDP, the US is grey, the Eurozone is dark green, Japan is light green, and China is in blue. And they're not just expecting a one-year bump in GDP, it'll extend into 2022. But by the time we reach 2023, notice that the numbers are looking sort of similar to what we saw in 2018. And it's not just PMI indices which suggest that economic growth is going to be strong. This shows how growth forecasts have been revised from their pre-pandemic numbers from the IMF. And for the US, growth is actually higher than it would have been without the pandemic. And although it's not broken down here, the same is true of Canada. And across the advanced economies generally, you can see the impact of the pandemic is negligible. That's because they could afford to have very generous fiscal stimuli, greater government spending, and also monetary stimulus from their central banks. Whereas if we look across emerging markets, excluding China, the impact of the pandemic has been extremely negative for growth. So in Asia, excluding China, they're expecting almost 8 percentage points lower GDP as a result of the pandemic. There's also a big negative impact for Latin America and the Caribbean, Sub-Saharan Africa, and the Middle East and Central Asia. So it's certainly not true that growth will be great across the board. For large parts of the emerging markets, the impact of the pandemic has been extremely negative. To extend our fire metaphor, what's the kindling which is going to kick things off? This is a breakdown by country of the percentage of people which have received a COVID-19 vaccine. Now, generally for developed markets, either a large proportion of the population has already been vaccinated or the number of vaccinations is increasing rapidly. It took a while to get going in Germany, Italy and France, but even for those countries you can see those numbers increasing rapidly. In poorer countries, the percentage of people vaccinated tends to be much lower, and that's true for example in Brazil and India, but even in some developed markets like Australia, the level of vaccination remains very low. But what's encouraging is that in countries where vaccination levels are high, generally we've seen deaths fall very dramatically, and we've also seen levels of infection also drop very dramatically. And that's meant normalization of economic activity, which is great news for the equity market. Now in the UK, the Office of National Statistics has started publishing high-frequency data to monitor recovery from the pandemic. And this data, which comes from OpenTable, looks at the number of UK-seated diners week by week. And the data is scaled such that before the pandemic in 2019, the value was 100. Notice how when we had the first lockdown, the activity fell from 100 to 0 because nobody was going out. Then as the economy opened up again in the summer of 2020, notice how the activity very rapidly increased, both in Manchester, which is the dark line, and in London, which is the blue line. Then we had a second lockdown when table bookings fell almost to 0, but recently notice how those numbers have increased very rapidly. Not only have they recovered, but they've gone well above levels before the pandemic. That's certainly true of Manchester and for the UK as a whole, although not so much for London, at least not yet. And that suggests there's pent-up demand. We've been locked up for so long, we're extremely keen to get out and go out for dinner. And in the UK, we have a payment system called CHAPS, where we can pay for things very quickly with our bank cards. And so the ONS has used that data to monitor activity for different types of purchases. Again, this is scaled to 100 for pre-pandemic activity, and the green line here at the top shows what happened to staple spending. So that would be on essential goods like food and utilities. That was hardly affected by the pandemic because, of course, we had to carry on spending on food. Whereas if we look at social spending, so that would be things like traveling and eating out, that was impacted hugely by the lockdowns, but that too is now starting to recover. We also saw a big negative impact on delayable spending, and that would be for purchases of clothing or furnishings, but that too has also recently started to recover very sharply. So what's interesting in this data is it shows that we're almost back to pre-pandemic spending, at least for these categories. Now, if we look at high-frequency data for other countries, we see a very similar pattern. In some sectors, we see a lot of pent-up demand, and activity's already gone above levels that we had before the pandemic. And the countries where that's been possible are the ones in which vaccination levels have been the highest. Given this really clear evidence of recovery, why is it that the Federal Reserve has still got the pedal to the metal in terms of monetary policy? Beneath me here you can see the two pedals in an automatic car, and that's a great metaphor for monetary policy. If we push our foot down on the brake pedal, then that would be a tightening of monetary policy. The effect is to slow down the economy and hopefully to reduce inflation, while at the same time, hopefully, not causing a recession. But that's not what we see at the moment. Jerome Powell's foot is firmly on the gas. So what could possibly go wrong? In fact, we've also got a turbo boost at the moment from fiscal policy. The two are actually acting in concert, monetary policy and fiscal policy, both blazing at full power. And the worry is that that's going to drive us right off the edge of a cliff in terms of overheating the economy and driving inflation much higher. The Chicago Fed has a brilliant indicator which shows you how tight or easy financial conditions are at any point in time. If their financial conditions index is greater than 0, then that's an environment in which we've got tightening conditions. And that generally tends to slow down the economy. So here the Fed has effectively got its foot on the brake. And if the number's negative, that means the Fed's foot is effectively on the accelerator or the gas. And it breaks down that index into 3 subcomponents based on risk, credit, and leverage. And if you look at the bottom right of the graph, which is the most recent conditions, they're extremely easy for all 3 of those components. And really the pandemic was just a very brief interruption of a decade-long period with very easy conditions. So it's really no surprise that risky assets have done so well in the US over the last decade. Conditions have been so easy, it would be surprising if they hadn't. And if I mark the latest value of that index and extend it back to 1970, you can see that there were very few periods when conditions were this easy. And when they were for an extended period, generally you got a crisis afterwards. So during this extended period leading up to 2007, that was followed by the global financial crisis, and this decade-long period of easy conditions led to the dot-com bubble. So the reason why these easy conditions might concern us is that we could go from a period where we've got a boom to a period when we get a big bust. Given that recovery, why on earth is the Fed still keeping its stimulus in place? Now, part of the Fed's dual mandate is to ensure full employment. And this is unemployment, which is the percentage of Americans who can work, who are working, going all the way back to the late 60s. Now, just before this pandemic hit, you can see that the levels of unemployment were extremely low. In fact, they're almost at 50-year lows. And yet we still didn't see very high wage inflation. And during the pandemic, we saw customer-facing jobs, for example in the hospitality sector, suffer the most. And unemployment spiked up almost to 15%, then it fell very rapidly, but it seems to have slowed down somewhat. And it does seem to have plateaued recently. And while that remains the case, it's very difficult for the Fed to justify taking away its support for the economy. And here's Jerome Powell at the Jackson Hole conference, where he spoke virtually, introducing the concept of average inflation targeting. And what he said was that if inflation runs below 2% following economic downturns and never moves above 2% during the good times when the economy is strong, then over time the average for inflation will be below 2%. And that could undermine the Fed's credibility, because if it can't keep inflation at 2%, then it seems to be ineffectual. And that's why it's now going to allow the economy to run a little bit hot and for inflation to exceed 2% some of the time to bring average inflation back to 2%. Now, what the Fed used to do was look ahead and use models to forecast what inflation would be in the future. And at the first sign of inflation, it would raise interest rates. And one of the reasons for that was something called the Phillips curve. So the x-axis on the graph above me is unemployment, with high unemployment on the right and low unemployment on the left. And then on the y-axis, we've got a measure of inflation, one which the Fed likes a lot, called personal consumption expenditures. Notice that when unemployment was lower, what we saw was inflation would increase. And this led to the concept of non-accelerating inflation rate of unemployment. That would be the lowest possible rate of unemployment such that inflation wouldn't kick in. And on this graph, that might be around 4% unemployment. Any less than that, and you might expect inflation would suddenly kick off. But notice the date range for this data is from 1960 to 1969. If we look at the 50 years of data following 1970, suddenly that beautiful relationship completely disappears. It's no longer the case that when unemployment is low, we get a very large pickup in inflation. And if that's the case, then if the Fed starts to raise interest rates the minute unemployment reaches something like 4%, then it risks stifling a recovery in the economy for the sake of inflation, which would never appear anyway. Or as Mary Daly put it beautifully, and she's the San Francisco Fed president, most arguments today center around whether it's dead or just gravely ill. Either way, the relationship between unemployment and inflation has become very difficult to spot. And that's why the Fed is willing to risk slightly higher inflation with its average inflation targeting approach. It's clearly coming down on the side of wanting to get as many people back into work as possible and keeping monetary conditions easy until that happens. But if the Fed's fueling a big boom in risk assets, is that going to be followed by a big bust? Now, you might expect that if economic growth is strong, then stock markets would do very well. And yet if we actually plot GDP growth for several countries, that's what you can see on the x-axis of this graph, versus the real stock price return for that country's stock market. Now notice how it's not a positive relationship, it's actually a negative relationship. So for example, Japan had very strong GDP growth over this period, but pretty poor equity market returns, whereas Sweden had fairly low GDP growth, but very good equity market returns. In fact, there have been many papers which show this negative relationship between GDP and equity market performance. Now, one of the reasons why that might be the case is that companies sell globally. Particularly large caps tend to be multinational companies. So what we should be looking at is global GDP growth, not just the country's GDP growth. The second reason why there may not be a strong relationship is to do with dilution. If we look at where growth comes from, it tends to be the small or medium-sized companies which generate a lot of the growth, both for the stock market and for the economy. So if we buy something like a market cap weighted index, which is dominated by those big companies, we won't necessarily feel that growth from GDP. Also, during periods of strong economic growth, many new companies will float their stock, and that means the growth that we do get is diluted amongst many new companies. So if we just buy a subset of the largest companies, we'll see the earnings for our companies to which we're exposed get diluted amongst the newcomers. And then the final reason why there's this negative relationship, which is particularly true of Japan in the 1980s, is raised expectations. If everyone's really bullish about the economy, they're also bullish about the equity market, that tends to push up price to earnings multiples, and that tends to give you lower returns over the years ahead. So in the 1980s, Japan was effectively pricing in the next 20 years of growth, which is great if you'd bought before that was priced in, but not so great if you bought once it was priced in, at least not for the next 2 decades. And that also seems to be true of the US at the moment, where the forward PE, the price to earnings ratio, is at very high levels. And in fact, you don't need to look very far to see examples of exuberance in the US equity market. So for example, these two meme stocks, GameStop and AMC Entertainment Holdings, both of them are currently trading at negative forward price to earnings ratios. That's because they're loss-making companies. So if we take the price of GameStop today and we divide by its projected 12-month earnings over the next 12 months, we'd get a number which is minus 342. And similarly for AMC, it's forecast to make a loss over the next 12 months. So that also has a negative price to earnings ratio. In fact, S&P Global Ratings has said that recent capital raises have improved the near-term liquidity for AMC, but its capital structure remains unsustainable. In other words, it's still teetering on the edge of default. So when you see a rally like this for a stock which is effectively on its last legs, that's a clear sign of exuberance priced into the US equity market. And Mohammed El-Arian, who used to be an amazing fund manager at PIMCO for many years, put it beautifully in a recent article called "The Federal Reserve is no longer market's best friend," where he says what the Fed should have done is cautiously tap on the brakes, just like the Canadian central bank. In other words, slightly raise interest rates in order to see what effect that would have on the economy. But instead, the Fed is fueling the loosest financial conditions, as we already saw with that financial conditions index. Why is that a problem? Well, if inflation does pick up, the Fed might have to slam on the monetary brakes. A very rapid and unexpected increase in interest rates tends to have a very negative effect on risk appetite. Whereas if it gradually increases interest rates and signals it well ahead of time, then that tends to be much less negative. And the other risk is that a very rapid increase in interest rates actually creates a recession. So while I don't buy into the narrative that inflation is going to stay high for an extended period of time, I am worried that the Fed's very easy policy is going to stoke a huge rally in risk assets, and that ultimately that's going to end in a very big correction. I think that's a much more likely risk case than an extended period of high inflation. These are the kind of topics we discuss all the time in our Patreon community, and to learn more about that, just click on the link beside me and in the description below me. If you do that, you get access to Slack, so you can ask me questions anytime you like, but also members of our community, of which there are now over 500, will be able to answer your questions too. And you get access to a wide range of videos which are only available to members and which you can vote on. So, as always, thank you for listening.